Do you ever wonder what stage you are at in your wealth building journey? Check out this episode of Wealth on the Move, the podcast, where we talk to Nick Maggiulli, author of The Wealth Ladder, and how he talks about every stage of the wealth ladder requires different decisions and different advice. And the biggest risk could be following the wrong advice at the wrong time in your wealth building journey. Check out this episode of Wealth on the Move, the podcast. Your life journey doesn't stand still, and neither should your wealth. Welcome to Wealth on the Move, the podcast. All right, welcome back to another episode of Wealth on the Move, the podcast. I'm your host, Will Hoffman, founder and president of Hoffman Wealth Management. And today, 6 months in the making, we have a guest to talk to us. I think it's a perfect guest for a podcast titled Wealth on the Move. We have Nick Maggiulli, author of The Wealth Ladder. I know Nico in our office is a disciple of this book. He has cited it in every meeting since he finished reading it. Nick, welcome to Wealth on the Move, the podcast.
Thanks for having me on.
I'm excited to talk to you. Where I first recognized your work was an article that you wrote for Y Charts a few months ago about a rebalancing strategy. And I'm sure that's going to work into a little bit here. But for our listeners, tell us a little bit about yourself. You're the Chief Operating Officer for Ritholtz Wealth Management, a firm that we have a lot of respect for. Two founders and folks doing everything the right way in this profession. So tell us a little bit about yourself and your role with Ritholtz.
Yeah, so I'm the CEO of Ritholtz Wealth Management. I started as a data scientist in 2018 and kind of was just in there and trying to analyze their data, trying to help them make better business decisions. And over time, I just kind of got more responsibility, kept doing more and more stuff. And now I help run the trading team. I do billing and a host of other things. And so it's just been a long road of me, trying to add value where I can. And I do a lot of that through data and through programming and different things of that sort.
And now through your books.
Yeah, that's a separate thing. So me, I have a full-time day job where I actually am the COO there. And I started blogging in 2017, which was about a year before I joined Ritholtz. And that's actually kind of how they found me, was through my blogging. But I was out there just, blogging week after week. And, I've been doing it for almost 9 years now. It'll be 9 years in December 31st. So we're at basically 9 years at this point. And yeah, once a week I write a blog post. And then from that, I was able to take a lot of that content, put it into my first book, Just Keep Buying. And then that was in 2022. And then my latest book, The Wealth Ladder, just came out this year.
Yes. And excited to get through it. It's great because, our podcast is titled Wealth on the Move. We're always talking to busy families and active retirees and on how to not necessarily just spend their wealth or manage their wealth, but also build their wealth. And the Wealth Ladder kind of touches on different phases, and we're going to get into all these phases, but different phases in someone's wealth building journey from zero up to $10 million. Am I correct?
Yeah, I mean, technically it goes beyond 10 million. But
yeah, let's hope.
For most people, once you get to 10 million, that's you're definitely set.
Yes. And wealth building, you talk about it's not one strategy. It's a ladder of strategies. You're starting with one, and by the time you get to the top of that ladder, these strategies change so drastically that the decisions you were making then kind of become laughable when you get to the top of that ladder. So I guess the biggest question I want to ask, and hope we answer in this episode, and I want to give you a chance to answer this now, is when it comes to building wealth, what's one big misconception that folks have when it comes to how wealth is actually built?
I think the biggest misconception, at least in the United States, is that it's based on how much you spend. And of course, that's true in the extremes. If you have a very, very high income and you spend an extraordinary amount, yes, you will to not build wealth. But for most people, most of the data shows overwhelmingly spending is not the issue, it's income, right? And income is the issue. And so if I had to pick one belief I could just fix in everyone overnight, it would be that, your latte is not the problem. Your avocado toast is not the problem. You're just not earning enough. And no one wants to talk about that. If you look, and this is not just true in the US, I've looked at data in Taiwan, I've looked at data in other countries, and savings rate is positively correlated with, income level. The higher the more someone earns, the more they tend to save as a percentage, right? Not just absolute saving. I mean, even as a percentage basis, it goes up, which shows
Oh,
the more
wow.
you make, the easier it is to save, right? I mean, if you think about it logically, you only have one stomach. If your income goes up 10x, you're not going to increase your calories by 10x. I hope
Right.
not, right?
I
But
hope not.
and
Right.
even and you're not going to even increase the cost, even if like, okay, maybe you're going to buy higher quality food, but are you going to spend 15% more, maybe 20% more? You're not going to go and 10x your spending on food at home just because you make 10 times more, right? And so that's true of basically every spending category. At some point, you max out. There's some that you could kind of keep spending, like private, flying private, you can kind of just spend infinitely there. But besides like a
Right.
few categories, like you're not going to spend that much more in that category once you kind of your needs are met. And so that's the main thing there. And that's why people with more income tend to save more, because they just like they buy the things, maybe they buy slightly nicer things than other people, but not that much nicer. And they have excess, and that excess gets saved, and then they invest it, and then it makes them more money.
Right. And one thing that, being on the front lines for the last 23 years in this profession, working with these families and active retirees, the one thing that I noticed that your book separates so nicely is what we see and where folks are making mistakes is they're following the wrong advice at the wrong stage in the ladder. And they're just getting started and immediately want to get to that top rung, which, listen, that's where we all want to be, right? We all want to hopefully, save and earn and invest to get to that top rung, but we negate some of these very important steps and things that we should be doing at those bottom and middle rungs, that because CNBC doesn't tell us that. CNBC is talking to the hedge fund manager, or the Wall Street Journal is talking to those folks, and the folks in those bottom rungs start following the wrong advice at the wrong time.
Yeah, I think the reason for that is just like the advice that's popular is not necessarily the advice you need to be following. And once again, CNBC or any sort of financial media is trying to put out entertainment, they're trying to put out news and information. And so they're trying to get that out for those people that are day trading, that are trying to get information, if that's based on your career, that makes sense. But for most people, what happened to Nvidia's earnings or Tesla's earnings doesn't matter all that much in the grand scheme of
Right.
things, right? And so unless you're a shareholder, a large shareholder in one of those companies, those things don't matter that much. And people like to focus on a lot of these things. And so I think the main takeaway for people who are just starting out, it's like, okay, where should you be focusing? And it's not that you can't follow a higher level strategy on a lower level, just there's risks associated with that, right? Like if you just look at the data, like the absolute wealthiest people on the planet are all business owners. Does that
Right.
mean everyone should go out tomorrow and start a business? Like the answer is no. I mean, for a lot of people, that's not the right choice. They may not have the resources to do it. They may not have the experience, right? There's a whole host. They may not be just personality wise, that may not be a good fit for them. Like, I don't think I would be a great, business owner to go out and start my own business and do this. I technically have a business like an LLC, but it's like just owning the blog income and the book income, right? Which is not really a standard business, right? It's like, it's
Okay.
something that's kind of very passive. It just sits there as like almost a container for the work I do, writing and blogging. So I think in terms of like an actual business owner, it's a very different skill set and a very different way of looking at the world. And I don't think it's right for everyone. And it may be right for people, just not yet. And so that's another thing I try to talk about. And why do I say not yet? Because maybe you haven't built the wealth, the skills, the experience to go out on your own. And that's something I try to emphasize in the wealth ladder.
Yeah, and when you say not yet, I want to talk about these early rungs. Talk a little bit about what you talk about in the book, and these pretty early on rungs, folks right out of college, right in the beginning of their career, really starting to really focus on wanting to build wealth. What matters the most at those early stages?
Yeah. So just to give a high level understanding of the framework, the wealth ladder breaks wealth into six distinct levels. Level one, and this is your net worth, by the way. This is all your assets minus all your liabilities. So everything you own minus everything you owe to others. So you take your house, your car, include everything, your stock portfolio. That's your assets
And not
column.
just not
You
just liquid,
Yeah,
illiquid as
everything.
well. Okay.
Everything. Yeah. I mean, and you want to evaluate as best you can. Obviously, you want to be conservative, right? You put all that together, then you subtract out any sort of liabilities, any debt you have, whether it's mortgage debt, student loans, etc. And that's your
Right.
net worth, right? And then based on this, you land somewhere on the wealth ladder. Level one is less than $10,000 in net worth, also includes people in debt. That's about 20% of US households. Level two is $10,000 to $100,000 in net worth. That's also about 20% of US households. Level 3 is 100,000 to $1 million in net worth. That's about 40% of US households. So the bottom 80, you say 80% of US households have less than $1 million in net worth. Then 18% of households are in 1 million to 10 million. That's what I would call like the upper middle class. And
Right.
then 10 million plus is that's like the rich or super rich even. And that's 2% of households, right? And so you can
Okay.
break this out. 10 million, technically it's 10 million to 100 million is level 5, and then 100 million plus is level 6. But for practical purposes, I like to combine those levels sometimes, just because it's the top
Okay.
2%. And even when you look at level 6, like it's like 10,000 households. There's like 10,000 people in the United States that have a net worth over $100 million. It's a very rare feat. It's very difficult to pull off, but it does happen sometimes.
Okay. So in those early rungs, that first and second rung, um, what are what are the focus areas where folks need to be spending their time and focus and energy, um, and ignoring the inappropriate advice that's coming in at higher rungs?
Yeah. So in the first rung, specifically level 1, less than $10,000, the thing you need to do before anything else is get to some level of financial safety or redundancy, an emergency fund or something like that. I know people say this all the time, but
Right.
what you really need to avoid is you need to avoid getting caught in what I would call a bad luck cycle, right? And so you can just think of like something like, if someone in level 3 or level 4 is driving to work, their tire blows out, it's an inconvenience, it's annoying. They call AAA, they call a tow truck, whatever. They get it fixed and they move on with their life, or
Hmm.
they even change it themselves and move on, right? It's an annoyance, right? It costs money,
Right.
whatever. They just move on. If you're in level 1 and that happens, you may not have the money to repair it. You can't get to your job. You lose your job. You can just imagine all the domino effects of bad luck. That one little unknown event can then lead your life into a financial tailspin. And so, the thing I try to tell people on level 1 to focus on is get some sort of financial redundancy, get some sort of safety so that you can get out of level 1. Because once you're out of that, once you have that breathing room, it's like night and day. And I've read a lot of studies on this. I've read anecdotes of people talking about this, especially just look at what happened during COVID when all these COVID stimulus checks came in, and they weren't even $10,000. They were much less than that. But people who were, paycheck to paycheck for a while, for the first time, like, wait, I'm not going out and spending money. I have extra because of the stimulus check. They felt a sense of relief for the first time in maybe their lives. And
Maybe
so
forever.
you
Right.
see how important just having a few $1,000s even is in terms of your stress and your well-being. So try and get to that, as quickly as you can. And of course, you don't want to go too crazy. I mean, I'm not someone that tells people to cut their spending. I think if there's any part where you can do that, just do that a little bit in level 1 just to get that safety. And then you don't have to worry as much. But that's why I say in
Right.
level 1. And level 2, I think it changes a little bit. I think it's not as much about safety because you already have some assets.
Hmm.
I think it's more about getting the right skills and the right education to improve your earnings over time. And I don't just mean getting a degree, as you can see now. Even like recent college grads are having like that unemployment rate is almost the same as just people with a high school education that are unemployed. So for the first time in a long time, like college graduates are now starting to catch up with just high school graduates in terms of
Hmm.
the unemployment rate. So things are happening in the labor market due to AI and other technological changes that are making it more difficult for younger individuals to get those entry level jobs. So it's not just that type of education. You have to think more holistically about education and how you can, improve your skills to increase your earnings over time.
Sure. I mean, someone they can watch 3 hours of YouTube every day and increase their skills at the same trajectory as somebody that's studying for finals right now. That's well within the capabilities. And I think in being on the front lines and working with folks that are in those first two rungs, their first questions are how many shares of Nvidia can I buy, or how much Apple should I own? And they're asking the wrong questions at the wrong time. You have to admire their ambition, but there's other things to focus on: the safety or emergency fund, and then the skills. In addition to that, once they achieve, let's say, a $15,000 emergency fund, it starts to build the momentum that, okay, this is what success looks like. This is what it feels like to have this wealth. And maybe you're the first person to accumulate this kind of wealth in your family, and now the habits, the things necessary to not just earn or save it but also keep it. And
Mhm.
changing your tires at the right time so you don't have that blowout, and
Mhm.
keeping those things progressing and getting that momentum, and having that sense of safety and security. So then we get to the middle rungs, and that's where you talk about transitioning from saving to investing. Am I right with where you are in those rungs there, and starting to think about risk tolerance and lifestyle inflation and things? What
Yeah.
I was going to say that lifestyle inflation, we did a whole episode on, um, really early on in the revival of Wealth on the Move, where we talked about not allowing that lifestyle creep to have a detrimental effect. And this is where I think that that's a big risk, if I understand your book correctly.
Yeah, it definitely can happen, especially with the big ticket items like housing. I think that's where you see it a lot, getting more house than you
Hmm.
can afford. And then that just leads to other things down the road. And if you actually look at, asset ownership, asset profiles by wealth level, you see like level two, level three, the biggest asset they tend to own is their primary residence, right? By the time you get to level four, it changes a little bit. It's still for a lot of people their primary residence, but it can be their retirement accounts, it can be stocks in general, and then it goes up from there. So I think it's just understanding that like investing gets, it's not that you shouldn't care about investing when you're in level one or level two. You definitely should, but it's just not as important. It doesn't move the needle as much as your income is, especially early on. And the example I gave in my first book, Just Keep Buying, was, you know, you look at, you're 23 years old, you just graduated, let's say you have $1,000 saved. Even if I get a 10% return, that's $100, right? And a
Right.
10% return is a decent return. That $100, I was going out, partying with friends, going to bars, this, that.
Sure.
With between the Uber, the dinner, the drinks, and everything, I could spend $100 in a night very easily. And that's like not an outrageous. I mean, it's a little pricey. I was in a more pricey place. I was in San Francisco at the time, but you have to realize like spending $100 going out with friends is not that outrageous in a night. And so that like you could spend your entire year's investment return in one night. You can spend that buying drinks for your friends, right? So I'm not saying you shouldn't go out with your friends. That's not the point of the message. The point is
Right.
focusing so much on investing when you don't have any money doesn't really make a lot of sense. And so I think the thing you need to focus on is your income, your career, building that out, and then care even more and more about investing as your asset allocation or as your net worth increases, and hence when you can mess with the asset allocation a bit more.
So how should folks transition their thinking as they climb to those middle rungs, and know that they're ready to invest, or ready to take on more risk, and what those investments should look
I
like?
think the thing you have to think about is like, I mean, what investment experience do you have? If you haven't invested at all and then you're just starting this out, you got to kind of like know yourself a little bit. Like, I think for most
Mhm.
people listening to this, they probably had some money invested during COVID. Like, how did they react during that time? Did they want to move to cash? Did they want to buy more? Did they like understanding how you felt during times of high uncertainty, high stress in your life is going to be very indicative of what you do with your money, right? Because if you're that person that, oh my gosh, as soon as there's a bad headline, I want to get out, you're probably taking too much risk in your portfolio, right? Or you're probably, you either need to accept that this sometimes happens or you need to take less risk, right? And so there's one of two ways to kind of go about that. And so when you're thinking about your allocation, how you want to do that, I don't think there's one perfect allocation because every person's in a
Right.
different situation. I mean, some people are, if you're single and you're 40 and you have a high paying job, you have a very different risk profile than if you have, a spouse and many children, or you have, aging parents you have to take care of, or you have other types of liabilities. Like your risk profile should be more based on your individual circumstances and less so just your age, right? So I think people don't take that into account, unfortunately. They don't think about what job you're in. Like, for example, I work at a wealth management firm. Like I take even less risk in my portfolio because my job, my income from
Yeah.
that, and my equity in that company, in the private equity I have in the company, that is like very linked to the stock market, right? At the end of the
Hmm.
day, if the stock market goes down 50%, like
Yeah, so does
the
so
revenue
does
of our
half of your
firm goes
income,
down.
right?
Yeah, exactly. And so anyone who's a financial advisor, works in wealth management, their income and their compensation is linked to the stock market and to the bond market and all that through financial markets in general. So you have to think about that. Given that, you probably should have a different risk profile than someone who works in the energy sector, someone who works in tech, et cetera. And so I think a lot of people don't adjust for that, and that's what you need to do. You need to adjust for those types of factors.
And how this is, in my opinion, the stages or the rungs where folks start to get ahead of themselves even more so than those early rungs. And maybe it's just because the dollars are bigger, but To your point about risk tolerance and risk profile, too often I think we worry about our own comfort level when it comes to risk. And quite frankly, who is comfortable with risk? It's like I liken it to getting surgery. Who's comfortable getting cut open to have surgery? None of us are, but listen, sometimes it has to happen so we can save our lives. Tying your risk tolerance also to what your goals are, to me, is something that if you want to achieve financial freedom, and that again is different for everybody, what risk profile is necessary to get there. And I think we get caught up in the risk profile being about comfort of our emotions, not achieving our goals. And I think this is the stage where you have to have those conversations. What ultimately are my goals? How do I want to get to these next rungs? I want to become work optional. I want to be able to invest in businesses rather than developing my career for the sake of my employer. Having those conversations and having those thoughts at this level is where it should and could happen, and where it becomes to be more quantifiable. I don't know if that's something you agree with or not, but that's just been my take over my career so far.
Yeah, I think as you kind of move up the wealth ladder, you're gonna see that those types of things come up. And I think also, I mean, you said people can get ahead of themselves a little bit. Like it's definitely possible at any stage in the wealth ladder, but by level three, level four, there's also a certain lifestyle that comes along with that type of wealth. And so if you're like, oh, I'm middle class or upper middle class, and you want to show off a certain lifestyle, like you're going to end up spending more to maybe fit in and look more like the typical person in that
Right.
profile rather than prioritizing maybe financial freedom. And so these are all choices people have to make, and you have to think about this in kind of a different way. But I agree with you that those are some of the issues that come up there.
Right. Because some folks, to talk about spending also, some channels, some programs will chastise folks for spending what is their perception of too much, let's say maybe on a sports car. And to me, and it sounds like you and I are coming from the same page here, if that sports car is a goal that you've saved and invested for, and listen, on a Saturday, I like to rip through the mountains of Western Pennsylvania in a sports car because it's something I enjoy. It's something that allows me to express creativity. It's something that allows me to decompress and enjoy my life. So what? Who cares what the impact is if it's keeping you within your financial goals? And they get chastised by other programs because, well, you're just buying that car because you want to look a certain way or be perceived a certain way. And I think we ignore those trade-offs sometimes. Of it's kind of hard to enjoy screaming through the back roads in a Honda Accord.
Yeah, no, I see what you're saying. And yeah, once again, I try not to judge people on how they spend their money because
Sure.
everyone's different. I personally like restaurants a lot. I've actually
Okay.
never owned a car. I do have a license, but I've never actually owned a car. So, because I've lived in places that have, usually pretty good public transit. Now, between that and Uber, I've never needed a car. I've just rented if I needed one for any sort
Okay.
of stay or something like that. But you see my point. Like everyone's different. Like I may
Right.
never, I don't want to say never, I'll probably own a car at some point. But for me, it's like, that is very low on my list of things. Like, I've never had to deal with insurance or any of that stuff. And so, but I
Congratulations.
spend a lot on restaurants. I spent so much money on restaurants in a year that some people would say, what? Like, but that's the thing. Everyone has to pick and choose kind of
Yeah.
what they like to spend money on, what they get joy from. And so there's no judgment there for me.
And making sure you're still, I mean, at that point it comes down to how important are your goals. If you want financial freedom, maybe that car has to wait for another decade or something. But that financial freedom, and not necessarily financial freedom, because all through your data and science studies here, I want to kind of get some insight when you get to those high net worth and ultra high net worth rungs. Can you talk a little bit about how those folks think differently about money?
So when you get to, you mean like level four, or you mean
Uh,
level five? Which
I would
level
say
do you
that
want
level
to?
5 and 6, when you're hitting that 10 million and above stage, how do folks think differently about money?
I think there's a larger responsibility to preserve it in terms of
Okay.
preserving it for the next generation. There seems to be this weight. There's also like maybe even feelings of guilt can come along, even though they may not have done anything wrong when they acquired it, but they're like, wait, I have so much, others have so little. Do I have this responsibility to society to give back more? I mean, all these types of questions come up. And then I think another thing that comes up, most people who are, 10 million plus, let's say level five, got it usually through some sort of business ownership. And so as a result of doing that, right, they now, they can see money as a tool, right? Like they can use money to go hire people and really change the world in fundamental ways. And especially at the really high end, you think about how Elon Musk used money, and he took it and he's like, oh, I want to buy Twitter. And he bought a social network, and now he runs it and he makes decisions for it, and he can change the way people interact because of money, because he took and
because
he
of
said,
his
hey,
net
I
worth,
want it
right?
to behave this way, right? So those are all the types of ways that money kind of changes as you kind of build more wealth. Like it can go from something that's just, something you use to consume for yourself to a tool to buy companies, change people's lives, really, impact history in interesting ways. And so that's just one way to think about it.
Do you think that there's and this is maybe just some reflection or philosophical, is there a point where in our individual money stops improving our lives? And I mean, to me, I think that's when that sense of obligation or sense of guilt comes in, where, um, you know, thinking back to the original Wall Street, with how many yachts can you jet ski behind? Um,
Mhm.
at a certain point, is it time to, okay, I can't do much more, and start fulfilling either obligations of looking towards future generations or towards community service, or somewhat.
Yeah, I don't know where that limit is, and I bet it varies for every person. But it's very easy to justify needing more, because once you're like, oh well, I can already fly first class on any airline anytime, but like, it'd be really cool to fly private, right? And that cost of that just shoots up, right? It's like exponential,
Right,
right? So to get into that, like the cost of the more extravagant lifestyles just shoot up exponentially. It's not like, oh, it's a little bit more expensive to do that. No, it's like 2 or 3 or 5x more expensive, or
right,
10x or 100x, right? You can just imagine, like, owning a yacht is expensive as it is, but you're not realizing, oh, I need to pay for the crew that runs the thing. That's an
right.
ongoing expense, right? So there's income, not just wealth issues. Oh, I can just buy this thing. No, it's like you have to buy it and then you have to maintain it. And so there's multiple layers to this, where you're like, it's not just you have to have wealth, you have to have income as well, not just a liquid asset that's paying you enough so you can cover a lot of these costs. So it's something to think about in terms of overall satisfaction and how you balance that.
I want to. There's a quote. I think it's your quote in the book, or if you took it from somewhere else. Having $5 million that's you're the poorest rich guy that exists, right?
That was
Because
yeah, that was from Succession.
or Succession, right? Having five
Yeah,
million
yeah.
dollars, you're the poorest rich person, or the richest poor person that exists. Because then you're always short. You can't have a private jet, but you still have $5 million.
Yeah.
So you're at that middle spot where it could be very frustrating. Is that the right word? I mean, not a lot of folks are going to have sympathy for you, but it still is a very bizarre concept to think of. Is, wow, I have $5 million, but still pretty limited in what I could do.
Yeah, I think the joke they used in the show was, not worth it to work, but you don't have enough to really retire. Like, what do
Right.
you do? Right. So it's like that's that middle ground joke. But I really think every person is going to be different. I think there's plenty of people that would be very happy with $5 million and would just be fine. But it depends how you get there too. If you work your way up there over years of hard work, you're gonna, right now you might be like, oh, if I had 5 million, I would never work again. It'd be great. Some people, when they start to get there, they change how they feel about that,
Yeah,
right?
their
And they might say,
ambitions
"Oh,
change.
actually, I need this or that." So I'm not saying that's true of everyone, but there are people where they don't have that sense of enough and they keep going because they don't know how to stop.
Yeah. Um, so through writing the book, and all of your analysis of folks earning and behavior, what behavior do you think hurts people's finances more that they should avoid?
I think probably the one that hurts people the most. I think a lot of people get emotional in market time. I do
Okay.
think it's one of those things that you see people, they panic over something, they move out and they don't know when to get back in. And like, let me just give you I think a thought experiment which would illustrate this.
Okay.
Let's say it's February 2020 and you get out of the market. You're like, oh, this is crazy. I see everything is starting to collapse. You get out, let's say early before the bottom. By the way, the bottom was March 23rd, 2020, right?
Right.
You didn't know that at the time. But let's say I came to you in February and I said, hey, here's all the headlines over the next year. I show you maybe every month I give you a different headline, right? And you're looking through it, right? And I'd say, okay, when do you want to get back into the market? Right? Every person would look at these headlines and say, "Oh my God, this is terrible. Like maybe I'll pick
Right.
2021, maybe I'll pick
when
2022. Like I don't know." the only correct answer, which I would basically no one would have gotten, would have been March 2023. Would have been literally before
Right.
the headlines got worse, right? So it's one of these things where even if you know the future, aka I'm giving you these future headlines, that doesn't mean you're going to be able to play the market that well. And I think that is something that people, it's very
That's a
hard
great
to
experiment.
conceptualize. Even if I gave you the answer, you're still going to get the test wrong, if that makes
Sure.
sense, right?
Yeah.
So it's one of the few things in life where you can actually have an advantage and still not have an advantage,
Still get it
if
wrong.
that
Right.
makes some
And
sense. Yeah.
yeah, I think back to the financial crisis, and it must be something about Marches being the bottom, because March of '09 was the bottom there. And folks would have told you were nuts if you said today's the day to buy stocks. Just go all
Yeah.
in on every stock you can today and don't look back. They would have thought you were wild. And their emotions, I think, hurt them way more than the markets do. And the markets, I mean, again, talking about risk, nobody wants to lose money. Nobody wants to be down. Nobody makes that purchase thinking, man, this is going to be down in the next decade. But
Mhm.
the emotions on how they handle that down are what hurt them more than the market being down. And then, we can try our best to deliver the advice, telling them exactly what you said, but having the stomach and the fortitude to stay in the market or to buy into the market is something only very few people have. What was it? Morgan, Pierpont Morgan was, when there's blood in the street, that's when your money should get in. And he's been right. It's a very hard pill to swallow to press that buy button on days like that.
Yeah, yeah, I agree
Um,
completely.
and all the advice in the world isn't going to change it, because that, again, that's hard. It's that behavior that, trying to get them to overcome that behavior is a challenge. If you're listening to this, we understand overcoming that behavior is a challenge. Both Nick's firm and ours working with plenty of households, plenty of firms, plenty of uncomfortable dining room conversations and dinner table conversations when the markets are down. And that's not lost on us. I know that Ritholtz does a great job. We try the same to, try to have those conversations and getting folks to understand that this is the time, even though it may be a very uncomfortable pill to swallow. I have a couple of rapid fire questions that I'd like to get to you with. First off, some of these may be repeat. What do you think is your biggest money myth that people believe that they shouldn't?
Yeah, I discussed this previously. I think it's that, you can cut your spending to get rich. I think that's
Okay.
completely a myth, and there's no data to support. There's obviously exceptions, but there's no real aggregate data sets that support that.
Okay. Um, the financial habit with the biggest ROI,
Buying consistently over time, like
the
just
dollar cost
continually
averaging. And
buying no matter what. Yeah.
okay. That's we love to tell our folks to automate that and don't even look at it. What's some advice that you received that you've maybe changed your mind about?
I've changed my mind about liquidity a bit and also rebalancing. I think rebalancing frequency doesn't matter as much as people think. I think they get very in
Yeah.
their heads about it. Just pick something. I do once a year because for taxes and whatnot. That's the simplest
Okay.
way. And in terms of liquidity, I value liquidity much more today than I did, you know, back when I first started. I'm like, oh, it's a liquid, who cares? But like being a liquid is, I think I've seen the other side of that where your money is now trapped. It's not
Yeah.
like I even lost money. My money, it's even worse than losing money. If I lost the money, I could count it against gains, right? So at least I
Right.
could use it for something versus now it's like trapped in this phantom vehicle that's just puttering along waiting to go under and it hasn't yet, right? So that's
Right.
that's the worst of both
That's
worlds, right? Because
as a business owner that is, my net worth is tied up in my business. Being illiquid sucks. It's hard. It is a challenge, because now you got to hope a bank recognizes the value of what you've built to gain some liquidity, and they're going to charge you way more than you should pay to get access to it.
yeah,
And so I agree there. The article that you wrote about rebalancing is one I keep on my desktop, because I mean, you're right. It showed that actually not rebalancing turned out to be the best strategy, because now maybe your risk profile got a little out of whack, but you kept that momentum in your corner. And I think that that's something that the auto rebalancing myth, and I agree, and we were taught the opposite when I was coming up in my career, that you should rebalance. It should be quarterly. It should be semi-annually, and your
From
evidence
a
proves
risk
that it.
perspective, yeah. From a risk
Yeah,
perspective, it's good to rebalance, but from a return perspective, I mean, once again, we're always balancing those two things, right?
right.
Like if you just think about like what rebalancing for most people, what rebalancing is, they're usually selling stocks which have typically gone up to buy bonds which have not gone up as much. Maybe they're flat or they've gained a little bit in general. So you do that over time, you're selling your high growth asset to buy the low growth asset.
Right.
That's by definition, in most periods, that's going to cost you money. However, in the one period where, oh, it's an '08, oh, it's a 2020, something like that, where stocks are down a ton, having that extra stuff, well, if you were to rebalance back, it's actually a benefit, right? But
Yeah.
those periods are rare, as you know. So I think that's kind of the counter to that.
Yes. And then what's your favorite book, or what book do you think everyone should read besides your own?
There's this book. This is not a financial book, but it's
Oh,
called The
okay.
Ends of the World. This is called The Ends of the World, and it's about the 5 mass extinctions in the Earth's history. And it's very good. It's a science book, but I really enjoyed it. And I'm really one of these science geeks and on the side. It's very interesting to learn like 99.9% of all species went extinct like multiple times. And it's like how did life come back from that? And it's just, I don't know, it teaches you a lot about like things making it through, and we're probably never going to experience an event like that because they're so rare. But like if life can make it through that, like what's, it kind of gives you some perspective on like how big a deal is like the stock market going down 20%.
Right.
Like literally like or like life as species as a whole had a 99.9% drawdown. Like who cares about, like, you know what I'm saying? It just gives you a little bit of perspective on things. I think
Yeah,
is very helpful. And it's
that's
also
great.
entertaining. So I think it's called the Ends of the World, if I remember correctly.
Yeah, I'm gonna make sure I check that out. So, okay, you have Just Keep Buying, The Wealth Ladder. What else are you working on?
That's it for now. I mean, I just came out
Okay,
with the Wealth Ladder, in July of this year. So it's only
right.
been, 4 or 5 months now. And so I'm basically like, hey, I just, it's the joke I say, oh, what are you working on another book? I'm like, go ask a woman who just gave birth to her second child if she wants a third one. And I'll give you the same answer. So,
Right.
but no, nothing. We're not working on anything else right now. Actually, my wife actually is pregnant
Oh,
and she's
congrats.
due
That's
next year in
awesome.
April. So that's my next big project is focusing on being a father and just trying to support my wife as much as possible.
Awesome. Your first kid?
Yes.
That's great.
So
That's great. As a father of 2 April babies, it's a fun time to have a baby. Weather's starting to break, so you're not stuck in the house during those early phases, and it's a
mhm.
fun time. So really happy for you. Congratulations, man.
Yeah, thank you. Thank you so much. Appreciate that, Will.
Last question. If listeners remember just one idea from the Wealth Ladder, what should that be?
Your strategy needs to change over time. I mean, I
Yeah.
think in the intro, I talk about this. Like a fitness instructor is going to give different diet and exercise advice to someone who's morbidly obese versus someone who's a well trained athlete. Take that analogy and apply it to your financial life. Someone who's in level 1 needs very different advice than someone who's in level 4 trying to get to level 5 or 6, right? And so thinking through that applies to basically everywhere in your life. I think a lot of people want to just give you one size fits all, just do this and your
Right.
life's going to be solved. And that can work for a lot of people to a certain point, but at some point you're going to have to change strategy. So just consider
Yeah.
that.
That's awesome advice. Everybody check out the book, The Wealth Ladder. It'll help you on your guide, no matter where you are in your wealth building life. It will help you and add some insight to your lives. Before we wrap up, where can folks find you? Where should they follow you? What's the best way to follow Nick?
I'm on LinkedIn at Nick Maggiulli. I'm on Instagram at Nick Maggiulli. I'm not on Twitter anymore. So I used to be there for a while, but I haven't been.
Okay.
And you can also find my website of dollarsanddata.com. Feel free, like you can reach the contact, email me, etc. And I
And that,
respond to every DM. So if you have a question, I respond to every single DM. So feel
oh,
free
that's
to send
awesome.
me something.
And you publish a weekly blog there?
Yep. Once a
Okay.
week, every Tuesday.
Awesome. Check it out. If you take one thing away from this, I can't express enough of what Nick said. Every stage of the wealth ladder requires different advice and different insight, and make sure you're getting that along the way. And if you want to follow us, hoffmanwealth.com is the best place to find us. I'm very active on LinkedIn, growing the Hoffman Wealth Management Instagram channel, and you can always watch us here on Wealth on the Move, the podcast. But until next time, please remember, keep your wealth moving.
Nick Maggiulli and Ritholtz Wealth Management are not affiliated with Hoffman Wealth Management and Private Advisor Group.
Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult with the appropriate qualified professional prior to making a decision.